So I'm so pleased to be here with you today, and I'm proud to take part of this debate as I'm representing the Essaffa, which is the sole and unique and mainstream financial institution of Sharia-compliant products in Morocco. So for this intervention, I would like first to introduce you with the principles and sources of this Islamic law, but which is related to banking and finance, and then I will make a brief overview on the global market of the Islamic financial services by giving some latest data in this field, and then right after I will talk about the case of Islamic finance in North Africa by shedding some light on the actual situation of countries such as Egypt and Algeria, Mauritania, maybe not Tunisia, because our friend from Zitouna gave all the information that is necessary for this country. I will further make a spotlight on the Moroccan market by talking about the recent changes and the actual situation of these services. I will maybe end my speech by talking about the main boundaries and breaks breaks the success of these Islamic financial services in this region, and also maybe talk about the opportunities that this financial system may have if all the rules are integrated. So this area of finance is composed of practices that are consistent with the beliefs of Islam and that are also characterized by an emphasis on socially responsible investment. And from that we can say that the entire banking system typically refers to all those financial activities that are compliant with the rules of this Islamic law, and that it is based first on the source of Quran and then on the source of Sharia, and it may also be based on other sources that are known as fatwas. So the basis of Sharia, which is related to finance and that have a fundamental impact on banking and investment, is the firm and clear prohibition of riba or interest. So in a way that any risk-free on a guaranteed interest on a loan is considered to be usury, and for that prohibited. And for this prohibition against interest, we can notice that it conflicts directly with the conventional banking system, wherein a large portion of this financial system is based upon interest income earned from deposits, earned from loans, and provided for deposits. So to overcome this situation, modern Islamic finance has had to develop mechanisms that allow to replace this interest income with other cash flows from productive sources. And these mechanisms must be all Sharia compliant and form the basis of the entire Islamic financial industry, as they constitute financial practices that are compliant with the rules of this Islamic law. And beside this prohibition against interest, there are other components of compliance issues that are mandatory for the entire Islamic financial system. So the second principle is uncertainty. So uncertainty in contractual terms and the conditions are not allowed unless all the terms and the conditions that are related to the risks are clearly understood by all the parties to each financial transaction. So the third principle is risk sharing and profit sharing. So all the parties that are involved in a financial transaction must share both the associated risks and profits in a way that big risk-taking and speculation are also not allowed in this financial system. The fourth principle is ethical investment, or what we can call Islamic investment. So investments in activities that are prohibited by the Quran are not allowed, and we can cite, for instance, investments in activities or industries that produces arms, alcohol, tobacco, and so forth. The fifth one, which is very important, is asset backing. So each single financial transaction must be tied to a tangible and an identifiable asset, because under Sharia, money is not considered an asset class, and for that it may not earn a return. So what we can conclude from these principles and sources that are related to finance is that the entire Islamic financial system is based mainly upon a socially responsible investment in a way that it is encouraging and enhancing investment in a real economy from one side, and limiting and restricting investment in virtual economy from the other side. And we can all remember the impact of this virtual economy on the world financial crisis. So for the global market, I shall begin with some brief history. So modern Islamic finance has existed internationally since the 1970s and has witnessed some significant growth during these 3 last decades. And it has risen from one institution in one country in 1975 to more than 300 institutions in more than 75 Muslims and non-Muslims countries. And historically, the Persian Gulf region and Southeast Asia, that it is led today by Malaysia, have been the key centers of this type of financing institutions. And in recent years, Sharia-compliant financing has expanded to Europe, mainly in the United Kingdom, and to the USA, and also to Africa, especially in Sudan. So Islamic finance today represents one of the quickest growing areas of finance in the world, and the global market of Islamic finance, as measured by Sharia-compliant assets, is estimated to have reached at the end of 2011 $1,219 billion, making a rise of about 150% in 5 years, with a growth rate of 25 to 30% per annum. In some countries, for example, such Iran, Sharia-compliant or Islamic finance is the mainstream financial institution, in a way that all the banking system has to conform to Sharia under a law which was passed in 1983. And hence it is ranking number 1 in the world, and it has, I think, $319 billion, which constitutes the entire asset of this country. In other countries, Islamic institutions exist alongside the conventional banking institution, and we can cite, for example, the example of Saudi Arabia, where conventional and Islamic banks compete and clients have the choice. But the greatest share of total asset is accounted for by Islamic banks, and the recent data had made these shares to 60%, I think. So for Malaysia, despite having a significant non-Muslim population, it is ranking number 3 in the world, and with a market share of 3% of its total banking asset. Today, Islamic finance is still showing a real potential of growth in the global market, and this can be measured by 4 key elements. So the first one is the expansion, expansion is still limited and restricted with the comparison to the conventional banking system, in a way that it doesn't exceed today only 2% from the whole financial industry. The second point is the resilience that this Islamic finance has had at the time, the past 2 years, and at the time when the global recovery has slowed and the conventional banking system, mainly in Western Europe, had remained under pressure. The third point is the general awareness today that of the necessity to have a financial system that it is based upon socially responsible investment, and that limits practices of speculation and investments in virtual economy. And the fourth point is that there is today a permanent core of actions on research and development to issue new products for financing the economy and to settle adequate tools in order to respond to specific financing demands and to compete with the conventional banking system. So we should also not forget that the demand on Sharia products is very important today, and that can be measured by the world's Muslim population, which exceeds today 1.5 billion Muslims, and there are that this population is constantly seeking for products that respond to their needs and to their religious beliefs. And there is also a potential, real potential among Muslims and non-Muslims investors that finds today in these financial tools a new way for fostering their economic development and for their activities. So for North Africa, unfortunately, Islamic finance is still underdeveloped, and the rankings of countries of North Africa in terms of Sharia-compliant assets are not even at the top 10, with Egypt, which has the longest history of Islamic banking in this region, dating from the 1960s, and where Islamic finance is most developed, is ranking only 12, and surprisingly, it is lagging behind the United Kingdom, which is ranking 9th. So today, Egypt had a total asset of $7 billion of Sharia-compliant assets, and a share of only 4.9% of its total banking assets. In Algeria and Tunisia, the shares are only 1.1 and 2.2% respectively of Sharia-compliant assets, and for both countries it doesn't exceed $1 billion. Morocco and Libya we don't have data because they still yet don't have fully fledged Islamic banks that are operating in this market. For the case of Mauritania, there is a little data, hence we don't have any statistics about it. So the Faisal Islamic Bank of Egypt, which is the most important bank in this region, but it's still a relatively small institution, had obtained its first license in June 1979, and it was followed by Al Watani Bank of Egypt in May 1980. Algeria has also two Islamic banks, Al Baraka Bank, part of Al Baraka Group, and Al Salam Bank, an affiliate of Al Salam Bank of Bahrain. The Al Baraka's bank presence dates from 1991, but the Al Salam Bank is more recent, and it is dating from October 2008. Libya, as I mentioned, has no Islamic banks, although there have been moves to open the largely state-owned banking system in recent years, and that was prior to the uprising of 2011. But today it seems likely more open to favor the development of Islamic finance. So, Mauritania has one Islamic bank, Al Baraka Bank, that was established in 1985, with half of the initial capital, which is subscribed by Al Baraka's Saudi Arabian shareholders, 10% by central bank, and 40% by local investors. For the case of Morocco, the financial authorities with the professional group of the banks, GPBM, developed and started the experience in October 2007 with a restricted segment of Islamic financial services by the launch of 3 products that meet the characteristics and rules of Sharia. And they permitted the use of Ijara and Murabaha and Musharaka contract, and that was referred as alternative products and no Islamic products. So the decision was made partly to lure investment inflows from the Gulf Arab states, in which the fast growing tourism and real estate sectors depend, and also to respond to a growing demand for Islamic products in the country, as well as to integrate the population which doesn't hold account banks in the official system, and which escape the official oversight. So today in Morocco, only 50% of the eligible population hold banking accounts, and then for the resilience that this population have against the conventional modern banking tools. So after this launch, Tijari Wafa Bank, which is okay. So brief experience on talk on Morocco, which is the pioneer of in the field, and which is the biggest conventional bank in Morocco, has begun the experience of alternative products in 2008 by launching 2 products, and then it was followed by the second bank, biggest bank in Morocco, which is Banque Populaire. The other banks preferred to wait and build on the experience of the starters. But despite these offers, the market dynamism hasn't been felt for both institutions, and the prospects for alternative products were discouraged by different breaks. So regulation and taxes made the gap very high between alternative and conventional products. The first break is that the alternative product were subjected to 20% value-added tax. At the same time, conventional banking products were subjected only to 10% on value-added tax, only on the amount of interest. And the alternative products also were subjected to double taxation in registration. And beside this, the problem of tax, there was another problem of compliance issues, because these products need to be supervised by Sharia boards in order to ensure the compliance of all the system. But the alternative products, as defined by the Moroccan regulator, were aligned only with the rules of AOFI and based on international benchmarks. And this created a clear inconsistency in the minds of customers. But there were further changes in 2010, and the Financial Act of 2010 was made to reduce tax and on alternative products, and alternative products looked more competitive and like a valid financial option to be explored. So the Moroccan market has 3 feasible ways to launch the implementation of Islamic bank. So the first one, it was through an independent Islamic bank, and which is not the case today because the financial authorities still haven't yet allowed the Islamic banks to operate. The second, it's through a branch which is independent at the level of management but remains an offshoot of the conventional bank, which is the case of Essaffa today. And the third case is by designating TILs devoted to Islamic banking managed by a special department with the conventional bank, which is the case of other banks in Morocco, such as Banque Populaire and BMCE. So I skipped Essaffa. I may just talk about some challenges and opportunities, if you permit it. Or we can leave it to the debate.
Just one, if you can...
There are...
because afterwards we will open the floor first to the discussions and to the audience. So if you can skip or just final remark?
Just 4 points on challenges and 4 points on opportunities. So the liquidity management is a specific problem that these Islamic financial institutions face in a conventional banking environment because Islamic banks cannot hold treasury bills, pay in interest or accept interest payments on the deposits with central banks. So the result in these institutions earning no returns on treasury holds, while the conventional competitors gain from such holdings. So the one solution for governments is to issue short-term sovereign sukuk, which is the case of Bahrain and Malaysia today. And for the case of North Africa, it is still not the case. But the other challenge is legal, regulatory, and tax issues, and this is related to the government support, and there is some issues on corporate governance, and human capital is also very important because today there is a shortage of human capital in terms of Sharia expertise related to finance. North Africa represents a great potential of opportunity because it represents 10% of the world Muslim population, and there is a low rate of banking account holders, as mentioned at the beginning with the case of Morocco, and I think it's the case of the other countries in North Africa. It's also can be considered as a way for creating capital and fostering economic development, and also to learn investments from the Gulf Arab states. Thanks for your attention.